It's another down day for the markets, the fifth in a row, as we get ready for the week's main event, the speech from Fed Chair Powell at the Jackson Hole Symposium in Wyoming. So what is it that we saw that got the markets in such a sour mood before the speech, and what is it likely to do? That's what we're going to unpack here. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to start with, as we typically do, is a look at the price action to see what it was that the markets were telling us here today in the most direct way possible, the prices themselves, and then consider where we go from here. Because the message now, of course, is going to very critically depend on a subjective reading of what the Fed chair says. So, episode 2 of this week's Event Risk. Episode 1 was the FOMC minutes. We had a little bit of an intermission with the PMI data to reset global growth expectations over the past 24 hours. We'll start there. And episode 2 closes the week. So, what did that intermission give us? Here's the price action for today. S&P down 0.35%, NASDAQ down 0.44%, gold down, dollar up across the board, Bitcoin, the risk appetite on steroids version of risk sentiment, essentially stock markets plus wanton speculative fervor, that's down 1.74%. This could not be a clearer sort of layout. Now, crude oil is maybe the odd one out here, but crude oil has been the odd one out from the macro narrative for a long time at this point. And it seems still to be generally stuck in the same kind of 62.30, 63.50 area that has been basically the center line going all the way back to, let's say, September of last year, as we were carving out the big and broad range on crude oil from somewhere around $74 a barrel down to about 54. The middle kind of oscillation axis for that range is somewhere in the vicinity of about 63 and a half to about, let's call it 62. And so, and that's on the new incoming CLV contract for October. So crude oil is kind of on its own right here. But aside from crude oil, the landscape could not be clearer. We very transparently see here. Rates went up. Risk appetite didn't like it. The dollar did. In an environment where yields are up and the dollar is up, gold weakens. So very straightforward. Gold doesn't yield anything. That makes it naturally something that weakens when the dollar and yields go up, because no one needs a zero interest bearing fiat alternative when interest rates and fiat, which incidentally is a yield bearing instrument, are going higher. So very clear cut here. Looking at the price action for the S&P, here's those 5 days of sell-off. And I bring up the chart and not just the performance, only to say that we haven't really had a meaningful move higher for the stock market since this right here. And that's the US CPI report. And all that report showed was that inflation was not as hot as feared. Not that it wasn't rising. In fact, core inflation went up to 3.1%. That's meaningfully higher than it's been in quite a while. As a matter of fact, 3.1 is the hottest that we'd seen since February. But the headline held at 2.7%. That's the highest again since February, but the expectation was we'd go up to 2.8, and that didn't happen. Moreover, the markets looked at goods inflation contributing just 0.22 percentage points to the headline, and most inflation still in services, and said, oh, well, good. The tariffs are not as bad of an influence on this as we might have feared. But of course, that 0.22% is also the biggest contribution from goods, and we'll get to that in just a second, that we've seen since June of 2023. So that inflation is creeping. But the markets looked at this and said, oh, well, goody. We're going to get our rate cuts because this inflation is not that bad. And that was good for a one-day rally. The 3 days thereafter do nothing. And of course, since then, we've come down. It's a soggier story for the NASDAQ, which also has the same one-day rally. It's then soggy for 4 days. We then sell off. So really, since that CPI data, stock markets have not been able to go higher. And it's because what we seem to have in that CPI data is tenuous at best. It is the sense that, oh, well, maybe, just maybe, we'll get some meaningful easing. And that seems to be the only thing that's really motivating these markets. So we look at these charts to say, if you want to see what's actually important to these markets, it is not this or that earnings report. It is not this or that comment from political leaders or this or that conversation geopolitically around the current wars, either in the Russia-Ukraine theater or the Israel-Hamas theater. It may not even be per se the comments that we got from Sam Altman this week, the CEO of OpenAI, likening the current AI situation to the dot-com bubble in 1999-2000. It seems like the one thing that's getting these markets out of bed is hope for rate cuts, and otherwise, they can't be bothered. So, what was it that set them off today, if this is our lens? Well, not surprisingly, we get a downshift in Fed rate cut expectations for September. Now we're looking at just 73.6% chance that we're going to get this cut. That's down from an absolute certainty that we're going to get it when that CPI report comes out. That certainty moderated to something in the low 80% over the past week, sort of hovering around 84, 82, 83. Today we take a meaningful step down. And now we're basically looking at a 70-30 spread. A little bit more in the direction of a cut. Why did this happen? Well, we were looking for the PMI numbers to come out, and boy, did they ever. And we have not just the US here, but the entire landscape that came out overnight across the major economies. And the story across the board is one of better than expected results. In Australia, manufacturing, better. Services, better. Composite, better. In Japan, better. Even though you get a little bit soggier on services and manufacturing is still in contraction. Things are slow, but it's faster growth than the prior month. In the Eurozone, again, soggy, but better than expected and better than before. In fact, across the board, manufacturing actually comes out of contraction mode. In the UK, better. Manufacturing is a little bit soggy, but services really powers on, and that takes the composite higher. And then, of course, in the US, again, better. The composite is higher. Manufacturing absolutely surges. After a couple months of contraction, it surges to powerful growth. Services, a tad soggier, but only just a bit. And when you look at where we are, we can see that really the composites change was not that massive, but it's almost completely powered by manufacturing rebounding here. This is really the story of this report. And of course, from a tariff perspective, it suggests that manufacturing is, at least from this vantage point, isn't being meaningfully hampered. And so what we've done is we've essentially returned on the overall composite reading here back to these heady levels from the second half of 2024, where we had the strongest growth at one point than back here in 2022. We're not quite there yet. We're sort of closer to early 2023 levels, but nevertheless, we're near the top end of where the growth range has been for the past 2 years, looking at these numbers. So not surprisingly, the market judges, well, in this kind of environment, we don't really need the kind of rate cuts that maybe we thought were necessary were we in some kind of a downturn. Lo and behold, Fed rate cut odds come in. But what's interesting is that the markets don't look at this and say, oh, goody, a stronger economy. They go, oh, no, this derails rate cuts. So if we look at this breakdown that we've seen, this, of course, stems from our kind of three-legged stool view of global growth, where 58% of global GDP comes from just three economies, the US, the Eurozone, and China. And then the rest of world, 42%, are mainly vendors that depend on the big three for demand because they export there. So think all of Central and Eastern Europe and the Eurozone. Think Australia and New Zealand, Southeast Asia, the commodity exporters of Africa and Latin America in the case of China. Think Canada, Mexico, indeed China itself in the case of the US. So we have a very disproportionate sort of story here for global growth, where it's really just these three economies that are driving the boat. And so when we look at the breakdown for these PMIs, then we're back into this world where Europe is getting a little better. We don't have updated August numbers for China yet. We'll see what those look like. Certainly the pickup in export orders baked into Australia's numbers are interesting in this sense, although it looks like it was mainly Europe and the US that drove the pickup in that demand. But of course, China is Australia's largest export market, so maybe finally there's something stirring there. But we can see that both China and Europe have really been hugging this center line. And of course, as ever, this is in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Europe is still kind of soggy here, although we can see clearly it's doing better. China has been stuck in a deflationary spiral for now essentially a year and a half, or 2.5 years, excuse me. So we're looking at probably more standstill when those numbers come out next week, although we'll see. But it's clear that this has become a one-engine kind of boat, where the U.S. is doing all of the heavy lifting. And so, not surprisingly, this is not an environment where the central bank might be motivated to cut, but also it's an environment where the markets very much want for there to be cuts, because operating in a world with a single point of failure is scary. And it would be good if that single point of failure had some padding and some support around it to make sure it doesn't fail if everything else can't really be a safety net. And so when you look at Fed policy expectations, they narrow in right alongside this conversation about the likelihood of cuts in September. So just like this has come down from about 83, 84 to now 73, 74, which is, of course, a meaningful swing for one day. So, too, the outlook for 2025 cumulatively is now into 42 basis points. That's obviously not in the same direction as what the Fed itself, even in all of its reluctance, has been forecasting. It is in fact on the hawkish side of that. But then what happens at the longer view, at the view for next year, is we go back out to 72 basis points, so a near certainty that we're going to get 3 cuts next year. That's, of course, very interesting to line up with what the Fed is saying, and really the essence of why this incoming event risk seems to be such a big deal, and why the markets, given data showing them a better view on global growth than they might want, ends up saying, you know what? Yes, growth is good. Yes, it's good for earnings. All that positive. We don't like it. Risk off. The Fed's latest forecasting for June has 50 basis points for this year. We can see here that the current rate is 4.25 to 4.5. The midpoint there is 4.4. And so from 4.4 this year down to 3.9, that's 50 basis points. For next year, the market has 3.6. That's only at one rate cut from 3.9 to 3.6. That's 1/4 percentage point rate cut, sort of rounded off. So 0.25, but rounded off to 0.3 since we only have one decimal spot here. So what does that mean relative to market forecasts? Well, the markets think that maybe even that 50 basis points is questionable at this point. So if we look at what we have here, it's 17 basis points into a second cut, and that's only a 68% chance, even lower than what we currently are looking at for September. So the likelihood that that second cut happens relatively flimsy now versus, let's say, even a few days ago, where both cuts were fully baked in. And at 72 basis points, we are only 3 basis points shy of pricing in a third cut. So for next year, it's 2 cuts fully baked, 88% chance of a third. And the market thereby is much more dovish than what Fed officials are saying. So the markets looked at this positive data today that gave us a better view, not just of the US economy, but of the global economy, and said, right, this means fewer rate cuts now, which will mean there will have to be more rate cuts later. And so that starts to tell us what they want to hear from the Fed chair. Now, ostensibly, the Fed chair's conversation is about the labor market, but the labor market is a conversation about inflation because the things actually occurring that are Fed relevant in the labor market are suddenly the sort of execution of what is now becoming a bipartisan skepticism of immigration, as well as the demographic shift going all the way back to pre-pandemic, that is the aging out of baby boomers out of jobs and the cohorts that follow them being smaller. And that being a story about reduced labor supply, which of course increases the price for labor as anything scarce and translates into inflation. So, what this conversation looks like will be what to do about a structural inflationary environment whereby interest rates probably have to be structurally higher than they've been in the preceding 40 years, from let's call it the early to mid 80s through to the pandemic, or maybe a little bit earlier, about 2017, which was a story of perpetually lower inflation and perpetually lower rates to match. Now, we heard already from the minutes in the minutes from the Fed's July meeting, we just had them earlier this week, that a majority of participants in the FOMC meeting, so the majority of Fed officials, see the upside risks to inflation as a greater concern than the downside risk to employment. We likewise see that they expect that the current Fed funds rate is not far above neutral. That is to say, there is not that much room to cut. And worrying about risks to long-term inflation expectations, even though they expect low economic growth in the second half of the year. So, if the main disconnect for markets is this right here, if this is, let's say, you could squint and 42 basis points and is close enough to 50, maybe we'll fight that battle somewhere in October and December if the Fed decides it wants to do the second cut or not. After all, September still is much more likelier than not to actually occur, though it's down. Then the real question is, okay, well, what happens after? This is where the disconnect is, to the tune of almost 50 basis points. And if this is then the message, there's vulnerabilities from elevated asset prices. That's not a recipe for rate cuts. The current rate is not far above neutral. Whatever cuts there are going to be modest. Growth might be low, but we're concerned about inflation expectations. And indeed, the inflation risk is greater than the employment risk. All of that together tells you, okay, maybe we'll sprinkle you some rate cuts near term. But if you thought there's an extrapolated rate cut cycle, you need to change your mind because that's not coming. Moreover, we can already see that inflation pass-through from the tariffs is starting to occur. As promised, here's a view of goods inflation. Yes, it is still much lower than services inflation, but the trend in goods is higher. The trend in services is, let's say, flat-ish. And over the past month, services inflation actually came in, goods inflation came up. Wholesalers are starting to pass through tariff costs to consumers. We saw the producer price index surge to reflect expanding wholesalers' margins on that score. Consumers have noticed their inflation expectations are up in the last consumer confidence survey. All of these things suggest the Fed is not there to jump out the window on rate cuts. And yet, this is still where the markets are. So the stage seems to be set for disappointment. And if this then is what disappointment looks like, at least in microcosm, then a Powell speech that sounds more hawkish than the markets have priced in and want to see, more so about next year than even what's going to happen through the rest of 2025, well, then the story for stock markets starts to look like it's going to remain grim. Rates look like they might continue to tick up, although to the extent that more and more easing is pumped into the long end, bonds at the long end might do meaningfully better than at the front end. The dollar probably has more room to rally. Gold probably has more room to sell off. Bitcoin may stay under pressure. And that is macro money for today. We are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. That makes it the last show for this week. Macro Money is, of course, back on Monday. I'll be there for Futures Power Hour on Friday tomorrow after the Powell speech to break it all down with Chris. I'll be also on Futures Power Hour as ever, Mondays and Fridays, as well as on First Call with Chris and with Tom on Sundays. Writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.